So good morning or good afternoon, everyone. Welcome to EPP's half-year 2018 results. I think most of you know that I'm Hadley Dean. I'm the CEO of EPP. Today we've got Jacek Baginski, our CFO, and Michał Szczecinski talking to us on operations. So what we're going to do today is we're just going to talk a little bit about EPP, talk about the growth and our H1 highlights. Then we're going to talk about the economy, what's been happening, both the good and the bad news, and then focus on our strategy, the why Poland and the why retail. Jacek will then run through the financial highlights, but in particular, we'll focus on our debt profile and our LTV. And then Michał will talk through our operations and unpack what has happened in the Sunday trading. We'll then go on to the acquisitions that we've made in terms of the M1 and Marcelin, and then talk about Młociny, which is now 76% leased or 86% with LOIs. Today we're expecting a big lease to be signed, but we shall share that with you hopefully in the coffee break. And then we'll talk about our office disposal strategies. And then we'll finalise on our outlook. So as always, questions at the end. We do have a live webcam, and for the webcam, I think the questions will come from you first, and then it will go to the floor. If that order is any different, please let me know. Good. So EPP at a glance. So as you know already, we are already one of the most dominant retail landlords in Poland. We now own just under 700,000 square metres of prime retail. So currently we own 19 shopping centres. The average size of our shopping centres is 38,000 square metres. So these are large, they dominate their catchment area, they're defensible, and therefore they're sustainable. As you can see, our two development sites in Warsaw, and as we go through, and I'm going to show you what our map will look like by 2020, and by 2020 we will have over 1 million square metres of GLA. We'll own 28 shopping centres. Młociny will open up in the second quarter of 2019. And importantly, we will have 40% of the population of Poland within a 30-minute drive time. So this is very relevant as omni-channel kicks in Poland. 50% or over 50% for many retailers of online sales are click and collect. So this is particularly relevant, and Michał will talk to that shortly. So 2 years ago, we weren't quite in this room, but we were in this building for the IPO of EPP. So what we just wanted to show you was our journey over the last 2 years and compare it to our H1 17 with our H1 18. So our total portfolio value was at 1.2 billion. This has grown to just under 2.1 billion. Our share of our retail portfolio has grown from 76% to 85% as we've executed on a strategy to sell our offices to help fuel our retail growth. The numbers of shopping centres have grown from 9 to 18, and of course the Marcelin deal closed in July, so that's now at 19. Our retail GLA has increased from 300,000 to 640, and again with the Marcelin just under 700,000 square metres. And our net asset value per share has increased by 31% from 1.04 to 1.37. The distribution per share, on top of hitting our guidance in 16 and year-end 17, we've increased our dividend per share by 12% to 5.82, and our LTV has decreased from 5.6% down to 50.9. As you'll remember from our year-end results in 17, we were at around 48% LTV, and we projected an uptick to about 52% with the acquisition of the M1 portfolio because we inherited the debt on that asset. But you can see we've already brought it down by 1% in the first year of and the first 6 months of this year. So we'll be talking to how we're doing this, and Michał will be unpacking that later. So my retail performance review. What we've done here is that we've looked at the portfolio as of the year end. We do not have the base data for the M1 portfolio, and we'll include that in our H2 numbers. and that's a theme you'll see out through the presentation. But our rent to sales remain healthy at 11.3. Our OCRs are around 15.1, and Michał will talk to that. Please remember, in Europe, we do not include the hypermarkets. So in South Africa, you include the hypermarkets in your OCRs. In Europe, we don't. So that's why it's at 15. And our like-for-like net rental income growth is at a very healthy 4.1%. Michał, again, will talk to this, but this is rental growth. It's the rollover of our tenants is quicker. It's short-term leases and rental growth. Our vacancy remains below 1%. Our footfall and our sales per square metre, as expected, has remained flat. This is the Sunday trading. Again, Michał will talk to this. So it looks like Poland is very much following the Hungarian example, where there was a dip, and then throughout the rest of the year there was a pickup. And this is what we're seeing now in our this is what we're seeing now in our portfolio, and Michał will talk to this. So it's as expected, and our WALT is at 4.64. In terms of our financial highlights, as you can see, our net property income has increased by 45% to 66 million. Our distributable earnings have increased by 32% to 48 million. And our dividend per share has increased by 12% to 5.82, meaning that we are on track to deliver our full-year dividend guidance of between 11.6 and 11.8. In terms of our balance sheet for the year end of 17 versus the half year of 18, we've seen an increase in total assets by 19% to 2.3, and our NAV per share has increased by 3.8% to 1.37. And as explained, our LTV has increased by 3.5% to just under 51%. So in terms of the macro story in Poland, so let's look at the good news and look at the bad news. So the good news is that the Polish economy continues to grow. The current government, it's really not being recognised for what it's done for the Polish economy. It's what it hasn't done for it. So it hasn't really tinkered with it. And indeed, I was speaking to Marek Belka, who's one of our non-executive directors, 2 days ago, and he asked. He was sorry he wasn't here. He's going to come for our year-end presentation as always. But as you remember, he was the governor of the National Bank of Poland, and he said a couple of interesting things. But primarily because when you look at the public debt that Poland has, it sits at 53%. The private debt sits in the mid-30s. And to use Marek's exact words, he said, if we do have another major financial crisis in the coming years, Poland could get lucky and swim through once again like it did in 2009. The other thing he mentioned to me, he said of particular relevance, is that Poland is a country of entrepreneurs. So what you will not or may not know is that there is over 800,000 companies of SMEs that are owned by Polish businessmen. 40% of Poland's exports come from these 800,000 companies. So that money is staying within Poland. So if Poland is known for being very entrepreneurial, the Czechs are known for being very innovative. But just to put it in reference with Slovakia, the top 20 exporters in Slovakia, 19 are owned by foreign companies. So this gives you a real sort of feeling of how entrepreneurial the Poles are. So on the more negative side, demographics. From Poland's perspective, it's not just a Poland problem. This is a Central Europe problem, and to be frank, it's a European problem. So Poland's not alone with that. What the government is doing is they're speeding up the visa process with the Ukrainians. It can take anything up to 6 months or 6 to 9 months at the moment. They're trying to speed that up to 1 month. And they're also looking at speeding up the visa process to other countries around the world. So how do the numbers actually relate to us from a retail landlord's perspective? So what you can see here is consistent average salary growth, consistent dropping of unemployment rate, of which both of those are leading to a significant boost in consumer spending. But what about the future? So where is this growth going to come from the future? And this is a slide showing the average monthly salary in Germany, and it sits at around 3,800 euros. The average salary in Poland is just over 1,000 euros. And this is where the growth will come in the coming years. So why the focus on retail? Well, as you know, Poland is a big market. It is 40 million population. Also, there are only 2 high streets in the entire Poland. So it means that 71% of all retail spend is done in shopping centres. And Poles do not see shopping as a transaction. It's not you go in to buy a pair of trousers and come out. It's a place where they see it as a leisure activity. It's somewhere where you go in, you meet your friends, you have a cup of coffee, you have an ice cream, you meet your family in a light, bright, safe, modern environment. So it's very much a light leisure activity. And when you combine that with what I was referring to earlier on, which is the omni-channel, so this 50% of online sales is click and collect, this has real relevance for shopping centre owners. On top, you see the limited new supply of shopping centres that is now decreasing quickly. You also have the decreasing prime yields in the major Polish cities, which is following that. And of course, at the end of September, of this September, I believe it's the 24th of September, Poland will be upgraded to the top 24 global economies in the Russell FTSE index. So that will also mean an immediate upgrade to the EPRA index. And as a company now, we're exploring how we can take advantage of that. Jacek.
So let me start from profit and loss accounts for the first half of 2018. As you can see on the very bottom of this slide, DPS for the first half of 2018 is ahead of the first half of 2017 by 12%. This was mainly driven by the growth of net property income and EBITDA of over 40%. Net property income was higher than in the first half of 2017, mainly due to acquisitions of assets that the company executed in the second half of 2017 and 2018, but also due to the operational reasons. The company recorded 4.1% like-to-like rent income growth for the first half of the year comparing to the first half of 2017. In regard to the revaluation of our assets, you see 2 positions below EBITDA. As you know, we are using the independent valuator to value our assets. And the valuations are done by that valuator twice a year. During the first half of this year, we recorded 28.8 million euros growth of fair value of our property portfolio. The valuation increase was largely driven by the increase of NOI, which was a result of various asset management initiatives, and not compression of the yields. We think that we can still improve NOI generated by properties and see further room for potential compression of yields. The increase of value in our investment in Młociny, you can see here the account called Share in Fair Value Gain and Profit of JVs, which reflects the uplift of the value recorded in our development project in Młociny by 25.3 million euros. That basically reflects the current stage of development of the project. The project is leased in 87% and scheduled to be open in the second quarter of 2019. Based on the lease contracts that we have already signed, and pending, we expect the project will deliver greater NOI than initially expected. Also, since the risk of the completion of the opening of this project significantly decreased, and we are very well advanced both in leasing and construction of the project, the valuator reflected that change in the compression of the yields. In regard to the finance income and expense, you see the growth from 8 million euros to 15.5 million in the first half of 2018, and that negative variance results from the higher average debt that the company incurred in the first half of this year, resulted from the acquisitions, but also we had some higher cost of debt, mainly driven by the fact that we started utilizing bridge to equity debt facility in the second half of 2017. Change in the deferred income tax provision in the first half of this year mainly results from the increase of the fair value of our assets versus their amortized historical tax base. Earnings adjustments, you see below net profit after tax, there is an adjustment of 33 million euros to the distributable earnings. That earnings adjustment between net profit and distributable earnings mainly result from non-cash elements like changes in fair value, profit of joint venture, and deferred income tax provision. In regards to the balance sheet, what I think is the most important is that our NAV per share went up by 3.8% from 1.32 euro cents per share at the year end of 2017 to 1.37 euro cents per share at the end of the first half of 2018. And this is, as I said on the previous slide, was mainly due to revaluation of the assets. Also, as I described on the previous slide, it's worth to underline once again that the value of like-for-like retail assets increased by close to 30 million euros, which is 2.2% uplift of value of these assets comparing to the year end of 2017. And again, that was mainly driven by the increase of NOI, with overall yields staying at the similar level as at the end of 2017, which is 6.4%. As Harley was presenting on previous slide, the prime yields in Poland, in major cities in Poland, are at the region of 5%. So we see and we think that there is a room for the compression of yields in our business as well. As you can see on this slide, we managed to restructure our debt. And as the result of that, you can see this comparing the graph on the left to the graph on the right side. We have a long debt repayment profile, and we build a liquidity buffer in the company. While, as you know, we had planned to do the bond issue in the first half of this year, we decided not to do so, as the pricing wasn't what we thought it should be. But in parallel, we were working on the other options, alternative options, which we subsequently secured and implemented. So you can see that we have successfully refinanced the debt maturing in 2018 of 100 million euros with the facility provided by the Polish financial institutions. It is a bond program as well, but distributed among Polish banks with a value of 200 million euros, of which obviously 100 million was utilized in order to repay maturing debt in 2018. Also, we refinanced the debt maturing in 2019 with the largest Polish bank, which provided us 150 million euros of facility with a tenor of 5 years. So as the result, we extended maturity of the loan from 3.6 years to 4.3 years. And in addition to that, as I said, we secured a significant cash buffer in the company. We have always been very focused on the LTV and wanted to keep it at a healthy level. As you can see, we previously reduced it from more than 55% to 47% at the year end of 2017. And this was mainly driven by the asset management and strong returns. As we previously mentioned, we knew that LTV was going to go up in the first half of 2018, and this was due to the acquisition of the first tranche of Metro assets. And we originally expected it to go up to 52%. But with the strong performance in regard to our assets, which resulted in revaluation of them, we managed to keep the debt below 51% as of end of first half of 2018. We are working towards, and we are confident that we will be able to demonstrate the deleveraging of the company within the next years, but this will be shorter than later, to the level of 40% at least. And this will be done through the combination of the disposal of the offices, through the demonstration of the results. The company will continue delivering good results to the shareholders, but also we are looking at different options of divesting some of our non-core retail assets. So we are very focused on bringing this LTV at the level of 45%. Michał, can you just continue?
Thank you, Jacek. Good morning one more time, everybody. So we'll start with the operation highlights. For retail. As you see here, the RTS and OCR is at the market healthy level. As Hadley was mentioned, we do not include the turnovers of the hypermarkets. You're going to see that number from time to time going up and down, yet then this is not in our interest to have it as low as possible, because with a high turnover base and the rental and the turnover growth, we want to take advantage and, of course, grow the rent. As you see here, we've managed to grow by 4.1%. I would like to also draw attention to our very low vacancy level, which only proves that our assets are still attractive for our retailers, and we can make good deals with them looking at the rental growth. Our sales remain stable for the first half a year, although I have to point out that majority of our shopping centers had a growth from 1% to 7%. The element that brought it down was effect of Pasaz Grunwaldzki and the competing scheme, which I'll talk to you in detail on the next slide. The footfall dynamic wasn't that big, but that's mainly also connected to the Sunday ban trading. And as you all know or remember, from March, the Sunday trading ban was implemented by the Polish Parliament, which means 2 Sundays per each month were closed. We were predicting that this, of course, will have in the first 3-4 months quite negative impact on the dynamic of the footfall due to the fact that simply customers need to adjust which Sunday is open, which one is not. They also need to adjust their typical habits of Sunday shopping together with families to do in the other days. As you can see here to the graph to the right, we have a split of weekdays and comparison to the like-to-like 2017 period of average growth of the shifting of consumer footfall in other days. So majority of the footfall that we lost on Sundays, and I also would like to remind you that our shopping center will remain open on Sundays due to our food and beverage and entertainment. We see that the shift came to the other weekdays, especially Saturday, Monday, and Friday. And also we believe that this adjustment period is slowly coming to the end. We already see it's flattened out, especially in July. I'm happy to announce that August was 3% up on footfall. So we believe that the numbers that we're presenting you, I think, will remain stable to the end of the year, and we're going to be happy to show you some growth numbers in the next year. On our project, Pasaz Grunwaldzki is one of our biggest urban shopping centers located in Wrocław. We had an opening of a competing scheme in end of last year from Unibail. And of course, we've been preparing ourselves for this and been expecting that, of course, Unibail will take part of the retail cake in that city. As you can see here, the sales went down by 10%. We've been actually expecting a little bit higher impact of this. The footfall kind of remained almost the same. Yet that our plan forward is still the same. We're still looking to optimize our tenant mix. We have already done a lot of good job on making sure that all our fashion anchor tenants are in the right size. They have their new concepts and they have their flagship stores built in. Currently with Inditex, we're working on making sure we bring all of their brands to, again, the flagship format. We are also able to attract new retailers to that project, and our occupancy is currently right now at 100%. At the same time, we are running two processes. Some of you have been on the Wrocław tour, you have seen it. We are upgrading the finish of the inside mall. We want to make it fresh. We wanted to make it more younger, just like the competition. And also we're looking to upgrade the food court from a typical canteen to a more lively urban type. And we're all planning to finish up all the work by end of the year. So hopefully with the great tenant mix, with the new look of that center, we'll be happy to rebound back to the initial numbers for the next 2 years. On Galaxy is profiting from a great extension that also happened last year. This is one of the biggest shopping centers in north and western Poland. Our footfall grew here by 16%. Our turnover growth on like-to-like 1%, yet then here we're not incorporating the comparison of the extension because we don't have a comparable data. And we will do it in the beginning of next year. But I think what's very important to say that the new part has already generated 53% on volume-wise in terms of the turnover. So that shopping center currently also is close to 100% leased. There's not much action to be done right now. It's doing very well. And we are as well here talking to one of the big international fashion retailer who's looking to take here next 2 years 5,000 square meters because looking for only one store in Poznań. And that definitely is going to put us as a #1 shopping center in the region. Galeria Echo, I think, already is the #1 shopping center within its region. It's because the biggest fashion entertainment offer between Kraków and Warsaw. Some of you also have seen it on our tour. The occupancy currently is now at 100% because we've managed to lease up the vacant units of 1,500 square meters on the first floor. And now also we're looking to expand the food and beverage component and cafes as that shopping center is still open on Sundays. Amber is one of our youngest shopping centers. We're very proud to announce that that shopping center is still on a fantastic growth path, same as Galeria Sudecka and Jelenia Góra, which actually had an 8% growth this year, both on footfall and 6% on turnover. Not much really to say. We are actually talking here as well with some other big international names to come into that project. I think also what helps us to maintain a nice steady growth on footfall is the fact that the nearby Poznań, which was always a retail destination for majority of the customers from Kalisz, now people kind of rather stay here in the city and do the shopping on Friday and Saturday. Acquisition developments. As you remember, we've been very happy about announcing the acquisition of the M1 portfolio, which is 12 shopping centers. 8 of them are M1 strong regional shopping centers. 4 of them are power parks. As you can see here from the map, that portfolio is complementary to our portfolio. And like Hadley was saying, gives us a fantastic access when all the tranches come into our portfolio to 40% of population. I think what's important to mention here is that 40% population has a higher 20 to 25% disposable income across Poland with combined footfall of 120 million people. And that definitely is going to put us into a #1 retail address for all the retailers, both existing and the one that I would like to enter Poland, as we cover majority of the affluent markets. On the key facts, the total GLA is 446,000. So together with the current number, will be above 1 million. Standalone NOI is 49 million. But I think what I like to plan here is that we've been very busy working together with Metro side on side under the current master lease to seek the potential for extensions. All of our assets are zoned. We have already identified 50,000 square meters, and we are working currently right now on detailed planning, tenant mix, construction budgets, and also some of the initial upgrades. That number is going to still grow because we also would like to implement some of the standalone boxes along the way, and that can happen parallelly to this process. And that potential extension will unlock additional value of 20 to 25% of the NOI. So hopefully by the end of the year, we'll be happy to present in front of our board the investment cases and the way I would like to do it together with Metro and start initiating as we come and as we have already the commitment from the retailers. I also have to say that majority of the projects are 100% leased, and we have a quite nice list of the retailers who would like to enter to that project. King Cross Marcelin, our new acquisitions. I'm very excited about that project. It's one of big project, 45,000 square meters. It's been on the market for many, many years with a very successful track record. It's located in the western part of Poznań. It's a very affluent part of the city. And I think also interesting to say is that in the last 4 years, Poznań had 2 big retail shopping centers being opened in the eastern part. But King Cross Marcelin hasn't been at all affected in terms of the footfall and the turnover growth. That project is also located to one of the largest office development in Poznań, which in the next 5 years will generate additional 10 to 12,000 working places right across the street. Definitely is going to have a positive impact on our footfall. Moreover, that shopping center not only is 100% leased, but also has a 10,000 square meters extensions opportunity. We already have some inquiries from some of the big retailers to enter their project. So we are right now in process of incorporating this, taking over. The first project review are taking place right now, and we'll be happy to look for the extension potential in that project. On developments, Jacek and Hadley were mentioning about Młociny, which is due to open beginning of next year. I think what's very impressive is the fact that 87% are leases signed and letter of intents are signed. And I think currently with one of our big international fashion retailers who's coming to Poland and decided to have their first store open in Młociny, unfortunately due to the fact that they're also a listed company, we're not able to disclose who that is. But definitely it's going to be a big game changer and definitely is going to give us a big advantage towards the existing Unibuy schemes in Warsaw. What's most important, as some of you, as we did on the tour, show you, project is located at the end of the metro line, next to a park and ride facility with 40,000 passengers daily, 150,000 cars. And we'll be looking to have a successful opening by beginning of that year. We are also working on enlarging the food court and entertainment area. It's going to be one of the biggest in Warsaw, including the cinema, the bowling alley, various kids' plays, and 50 restaurants and cafes. Towarowa 22, this is our flagship retail development in heart of Warsaw with close to 6-hectare site. We are working together with Big Architects, which is a big Danish urban architects, together with the city in order to make a proper planning and developing not only for 110,000 square meter development of retail, but also for additional functions such as residential, office, and hotel. And we see that discussions about the zoning will move on to 2019. We'll have a direct access to the metro line. We already have a quite big interest from the retailers to enter into this project. Thank you. I'll hand it over to Hadley.
So office update. So as you can see, we sold our 3 offices at the back end of 2017. That was the Triton asset in Gdansk, Westgate, and the A4 Business Park in Katowice. So that released 160 million. And we are now in the process of selling the Malta Office Park, all 3 phases of the O3 Business Park, and Symmetris 1 and 2. And I can tell you that we are in the final stages of negotiation on that. And the value of that is circa 250 million euros. So in terms of outlook as a company, we remain laser focused on these areas. Portfolio integration. We had to integrate nearly 200,000 square meters of retail this year. We are now 60 to 70% integrated into our systems. It's a big number, and we will be fully integrated by year end. Of course, we still have all the reporting numbers coming through. But from an asset management, I think what you can see is how well our asset and property management teams are working with Michał and Wojtek. They are all bonused in the same way, and it is building like-for-like NOI growth. We continue to recycle our assets, and we're now looking at some of our non-core retail assets with the objective to bring down our LTV in order to, in the near future, to obtain, let's say, investment grade. And we are, in conclusion, we are on track to deliver our full-year dividend and guidance in 2018. So I think now we move to questions, and I'm assuming that our colleagues at the back will tell us. So are we taking questions from the floor, or are we taking questions from the floor? Okay. Any questions from the floor? One additional point to make here is that next Friday, the JSE are very kindly hosting a Polish day where the ambassador will be opening up the session, and we'll be talking about Poland. One of World Bank's top economists, in fact, he's their senior economist in Beijing, will be coming to Poland and will be giving a presentation on Poland. And for those of you who are considering to invest in Poland or EPP, I'd recommend you attend. If you could speak to Cohen to make sure, because there are limited seats. We're in a smaller auditorium.
One point, I just want to add one point to my part. As you may remember, in the first half of this year, we were working on introduction of the DRIP program or policy, and wanted to offer this to investors. However, considering the liquidity of the company that we secured and the low price, we consider it to be significantly below the valuation of the company. We will not offer that program for the shareholders for the time being.
Thank you.
Hi, Adley. Excellent presentation. Thank you very much. One question I had is you mentioned that the bond program was pulled due to the pricing. Is it fair to assume then that the 250 million euros raised from the Polish institutions was at pricing better than one would have obtained on the bond?
Yes.
Yes, it's a fair assumption. So basically, as I said, we worked on the bond program with the European Bank in order to place the bonds on the European market. But at the same time, we had the plan B in place, working with the biggest Polish banks, and we ultimately decided to go with them mainly because of the pricing. So the price was more attractive.
So on that same vein, can we use the 2.38% cost of debt post the getting of that credit? Is that your average credit post the raising of the 250 million?
Yes, you can assume it.
Sorry, you mentioned the sales on the office building.
Yeah.
Can you just comment on relative to the book value? Was it under a premium or a discount?
This was, as I was mentioning, we are valuing these assets every half year. The last valuation was just dated as of end of June. So basically, the pricing that we are getting right now is to be at the fair value of these assets that we keep on the books, which was updated just like 2 months ago.
Just two questions, if I may. The one is just looking forward. There's fairly extensive development programs in terms of the two flagship projects in Warsaw in M1. Do you anticipate at some stage there will be a further equity capital raise? Just some depth on that. And then the second question, you indicated that Poland would be included in the FTSE Russell indexes at some stage, and you were doing some work around that. I imagine that would involve having to list on the Polish exchange or the Warsaw exchange. If you can just give some depth on that as well, please.
Sure. So from a development perspective, we are obviously, the Młociny acquisition or sort of development is well advanced. Construction is nearly complete, and it is fully financed. Any extension that we do on M1 or our existing portfolio will be 100% leased and will be de-risked as much as we can. And 100% of the construction would be through bank financing.
Thank you.
Anything you want to add to that?
And then the second property in Warsaw, would that require...
So we're still in the zoning phase with that. There's been local elections in Warsaw, so we think things will start moving again the back end of this year and next year, but that is still some way ahead. How would we fund it? Yeah.
So basically, again, as I said, we have the program of the disposal of our offices. The three projects are on the market right now. We still have 3 more projects. We will continue looking we'll be continuing looking to sell them. We think that we will, be able to sell these additional projects in course of 2019 and 20. So this is the first source of the equity that we'll use to finance developments. The other thing is that I was mentioning also during my part of the presentation, there are some retail assets that we consider being non-core assets. So we will also look at the market, at the valuation, and see if we can sell them. So this is, I would say, additional source of equity that we can recover in order to reinvest in the developments.
And by non-core, we also mean that these are assets that we have taken growth out of as well. So they may not just be smaller assets.
Thanks. And then the second question was there, just if you've got any detail or can make any comments about the what you're looking at in terms of Poland being included in the FTSE indices.
So I mean, this is it's obviously a difficult question to answer because we are reviewing it at the moment. But I mean, clearly you will be able to perhaps advise us more than we can at the moment as analysts. But clearly, to take advantage of the EPRA index, there would need to be some form of local representation, but it would need to make financial sense to our existing shareholders.
Hi, just with respect to retail versus office. So by 2020, how much of the fund will be retail? And could you see yourselves getting back into offices in a few years' time? And why not if Poland's economy is doing so well? It just seems, South Africa has office problems, but does Poland really have office problems that you have to completely abandon them?
No, I mean, the office market in Poland remains strong. However, we see more substantial growth in the retail sector. You have to, one of the biggest problems Poland has is it's a perception problem. Many of you who have been to Poland and have actually seen what a developed market it is. This middle class now is emerging and is spending like a Western European market. And so we believe there's more growth in retail than offices. It's not that offices are a bad market, but we aim to be out of offices by 2020. Does that answer your question?
Apologies, I walked in late, so you may have mentioned this already, but could you just talk about how Młociny valuation works? So you say you do the valuations every 6 months. We just had the June passed, and then Młociny comes online in the middle of next year's half. So currently, how much of Młociny is in the NAV is the build cost to date, or nothing of it? I'm not quite sure what is included in the NAV that you report. And when it gets completed, would it be valued at the build cost, which is, I think, is April 2019? And then will there be another uplift in June 2019? And roughly, is there any expectation of a value uplift in June 2019 for Młociny?
So basically, how the Młociny are valued at the basically at the, let's say, estimated cap rate at the opening, discounted by some risk related to the delays or overrun of the costs, less the capex that needs to be spent between now and the opening of the project. So basically, the project gains value over time once we spend the capex, and once we de-risk, and basically we can ensure the evaluators that will be opened on time. Then obviously, when the project is fully leased and opened, the evaluators will be reviewing once again the cap rates. There are two projects in the neighborhood. One of them, which is called Arcadia, is valued at the cap rate significantly below 5%. I can't obviously guarantee that the evaluators will follow the truth, but ultimately, bearing in mind that there is an alternative project nearby that is, I think, operating for 10, maybe 15 years, this will be, I think, a benchmark for the evaluators to look at the valuation of the Młociny project.
And please bear in mind, there is Warsaw obviously is the capital city. It has the highest income, and it has compared to the other major cities in Poland, because of the zoning and planning, it has one of the lowest per square meters per 1,000 inhabitants. So there's also that sort of pent-up demand.
Perhaps I just want to add one more comment on this equity discussion and the financing. So I described what we did in regard to the debt structure, that we refinanced and increased the maturity of the loans. I was also making a comment that we are not going to offer DRIP to the investors, but also answering to one of the questions, I was making a comment that we will be using the proceeds or the equity recovered from the disposals to finance the development of our portfolio. We think that the share price is way too low for us to go to the market as of now. And again, especially that there are other sources of equity that we can recover and deploy for investments.
Are there any questions on the conference call?
No questions from the conference call.
Okay, our friends in Cape Town are going to wait for us to give us a hard time down there on Tuesday morning. But thank you very much for attending our H1 results, and look forward to seeing many of you for one-for-ones, and also hope to see some of you on next Friday for the Polish Open Day. So please enjoy the hospitality with the JSC have put on for us now. Thank you.